In previous Chapter 3 videos, we have looked at all three main financial statements. Most recently, we have gained a better understanding of the various sources and uses of cash and how to summarize those with the statement of cash flows. In this video, we're going to look at how to create standardized financial statements and why that would be a useful approach. So what you will notice is that the construction of standardized financial statements is actually very simple. So a more important question might be, why would we do it? And to answer that, we can first quickly reflect on the sample balance sheet that we've been working with throughout the chapter. So this hopefully should look familiar by now. Suppose I were to ask you, how have things changed since 2018? What would you say? What if I were to ask, what can you tell me about the company's debt level? Or how can I think about the company's increase in accounts receivable? And what you can quickly see is that certain accounts, obviously all accounts have changed, and it's fairly easy to see whether it went up or down, but it's much more difficult to see the relative importance of those changes. And so standardized financial statements will give us an opportunity to look at accounts in relative terms to make it easier to compare. So the first reason to use a standardized financial statement is for easier comparison of financial information, and this can be particularly useful over time as a company grows. The second reason that we may wish to do it is as an analyst if we're trying to compare two companies that are of very different sizes. So in absolute terms, we're going to see very different size numbers, and in order to actually compare performance, we have to compare apples to apples. So we want to put those numbers in relative terms, and this is really useful if we're trying to compare two companies in the same industry. To get a better understanding of that concept, many people would look at Canada and the United States as both being, first world high income countries, but we also understand that the United States is much bigger than Canada. So if we're thinking about economic output, we can look at total GDP for sure, but oftentimes we're more interested in GDP per capita or per person so that we can compare easier. So the first standardized financial statement that we'll look at is the common size balance sheet. And again, the computation is really simple. We're simply going to compute all accounts on the balance sheet as a percent of total assets. And remember, we're always keeping in mind the fundamental accounting equation. Total assets on the left have to be equal to total liabilities and total equity on the right. So computing an account as a percent of total assets is the same thing as computing an account as a percentage of total liabilities and equity. So we'll go ahead and try this with this balance sheet. Let's look at accounts receivable. The computation is very simple. We're simply taking accounts receivable, dividing by total assets. We convert that to a percentage and very quickly see that it is 22.2%. So we make the change there, and we can do this now for all assets for 2019. And I will leave it to students to do all of the accounts on the liability side. But to get us started, we'll first do the total liabilities number. So in doing that, we see, okay, the total liabilities in 2019 is 64.3% of total assets. But notice how much more interesting it becomes when we do the same standardization for 2018. So we've done that over here. And so what you notice is that not only has total liabilities grown in absolute terms, it's also become a much higher percentage of total assets. So we would say that the capital structure of this company is changing. It's becoming much more reliant on debt. We've done the same thing over here for accounts receivable. And this is interesting because you note that in absolute terms, accounts receivable actually went up in dollar value from 2018 to 2019, but in relative terms, accounts receivable has actually become a smaller number, or smaller percentage of total assets. The next standardized financial statement is the common size income statement. Very simple. We're just going to compute all line items as a percent of sales. So here again is the same sample income statement that we've been working with. So we'll start with cost of goods sold. We just divide cost of goods sold by revenues. And here we quickly see that our COGS, our cost of goods sold, is 40.7%. So this gives us a quick sense of the gross profit margin of the company. In other words, we now know that for every dollar that the company earned, they had about 60 or 59 cents available to pay all of their other expenses. So again, we do this for all of the accounts, in each case simply dividing by total revenues there. And this is interesting. However, you would notice that this becomes much more interesting if we were to have data from another year. So suppose, for instance, in 2020, we had another income statement, and suppose that the dollar value of all of the accounts increase, but and this includes net income, but perhaps we notice that the cost of goods sold and our other expenses also increase as a percentage of revenue. So this would give us insight into the fact that although we are growing, our profit margin might actually be decreasing. So there could be something going on with our cost management there. Companies are always looking to grow their revenue, to grow their profits, but they're also looking at ways to become more efficient and more profitable. And so this gives us a quick way to compare trends over time, and certainly 2 years. Our final standardized financial statement is the common base year financial statement. Now, in order to calculate this, you're always going to need data from at least 2 years. So here's an example straight from the textbook, and I know that it can probably be a little bit difficult to see here. What we have is just a partial comparative balance sheet. So here we have just the asset side for some companies' balance sheet, but we have 2 years, 2014 and 2015. So if we look, for instance, just at the cash accounts, we notice that cash increased from 2014 to 2015 from 84 to 98. So if we divide the 2015 number of 98 by the base year number of 84, we get a ratio of 1.17. So what this instantly tells us is that our cash account has grown by 17%. So the common base year calculation can allow us to very quickly see how our accounts are growing. We can also consider whether or not we have balanced growth throughout our accounts, or whether some accounts are becoming relatively more important. So for instance here, it's not the case that all accounts are going up by 17%. In fact, it looks like on average they're going up by around 6%. But the increase in cash in growth terms was much higher. Accounts receivable went up by 14%, but inventory only went up by 7%. So this might start to give us clues about what the company might have done over the past year. Perhaps it looked to lower its inventory by giving its customers better terms. So it might have sold more inventory, but it's also owed more money for those sales. So that completes our quick look at standardized financial statements. In our next video, we're going to look at financial ratios. And what you're going to notice is that the framework or the approach is very, very similar. In all cases, we're just going to be taking one number or some combination of numbers and dividing by some other number. However, what we'll find is that depending on the numbers that we choose, the results will give us better insight into particular aspects of the business.